Forvest Global Wealth Management. Lyle, thanks for coming in.
Morning, Paul.
What is your take on these markets? Despite all the worry and uncertainty, the S&P 500 is up about 4% this early year of 2025. Are markets, in your opinion, getting ahead of themselves?
Well, that's always a tough one. You know, we're in a world now of unprecedented valuations, with the exception of sort of the dot-com boom. And so there's a valuation question, and valuations are high. But when it comes to expectations, there's two aspects that we look at. First is interest rates. And through 23, at the beginning of the year, carrying into 24, and then even a bit into 25, there was this anticipation the Fed would cut.
Right.
Well, that anticipation multiple times. It's come out. Like, I did a thing for this for our weekly meeting just over the weekend. 5 or 6 cuts were expected at the end of 23 to finish with 2025. That's now down to 1 in 2025 and maybe 2 in 2026. Mm-hmm. Interest rate expectations have been dampened. At the same time, earnings momentum, with the exception of a few names, is not that strong. And it is those few names that are carrying the week, the 493 being carried by the 7 in the U.S. With slowing earnings and less prospects for an interest rate decline, it's hard to make a valuation case for the market. But money just is going in. And fighting that momentum trend is very, very hard, as it's been over the last year and a half.
Talk to me more about your view of earnings performance in the most recent quarter south of the border. There are varying views on that. We've spoken to 2 people thus far this morning. David Rosenberg doesn't think earnings performance justifies the current valuations. Another portfolio manager from Minnesota took the opposite view. What do you tell us more about what you think?
Sounds like an American-Canadian thing there. Every week I look at something called FactSet Earnings Insight, right, where they do a nice analysis of what's gone on in the quarter reporting to date. I think we're about 2/3 of the way through, and it's interesting. All the numbers are up, but they're less than the average increases that we've seen over the last 5 years. So earnings growth is good, but it's less than the 5-year average. Revenue growth is good, but it's less than the 5-year average. What troubles me is the fact that 2025 earnings are now on a downward trend. A while back, I think they were 280. Now they're at 270. So people's expectations are not strong. And if we get any disappointment with NVIDIA, there's problems. Like, earnings momentum isn't quite as strong as it is. Cash flow or cash liquidity into the market is strong, and that seems to be what's driving stocks.
If I understand correctly, you are not invested in bank stocks on behalf of your clients. Is that correct? Or very lightly?
We are very lightly. And, in Canada, where banks are 30%, I think on average a client position is 4% or 5%. The dividend growth, we just don't see happening. And you could say the same thing for the pure Canadian utilities, or the pure Canadian utilities. I don't think there's a Canadian utility that really is all Canada, maybe with the exception of Ontario Hydro. Their yields aren't that great. But pipeline companies, which are quasi-utilities, have outstanding yields. You look at Canada, we got TRAP, we have Enbridge, South Bow. The average yield on those stocks is well north of 6%. In the U.S., they've got master limited partnerships. Their yields are 6, 7, in some cases 8%, compared to a paltry 2.5% yield, 3% yield on the global utility index. Canadian pipelines are a good place to be. And
so you are there on behalf of clients?
Yeah, they're steady cash flow companies. They're not the old regulated utilities that everybody kind of got used to in the 50s, 60s, and early 70s, but they have a really good, stable cash flow business that's highly predictable. At a time when the world is less predictable, we like that.
That's Lyle Stein on some sectors of the stock market he doesn't like, and one